Okay, hey class, Mr. Fashion here. Excited to jump into this first video. This video is on the fundamental accounting equation. So this video is going to get you to a point where you can make simple calculations about the fundamental accounting equation. I'll show you it in a minute, but the fundamental accounting equation is just assets equals liabilities plus owner's equity in a business. So the big thing really in getting to this point is just understanding what assets are, what liabilities are, and what equity is. And hopefully that will start to make some sense. And if you do understand these three things, you'll be in really good shape for the next lesson on balance sheets. Okay, so assets, liabilities, and equity. That's sort of the point of what we're getting at here. Another thing I'll do at the end of this video is I'll just give you a question to keep something in perspective about the meaning of equity. And that's just something you can think about later. But anyway, back to it. So, assets, liabilities, and equity. If you've taken entrepreneurship or intro to business, you've seen a balance sheet before, which means you've seen assets, liability, and equity before. My advice is just stick with this because we're going to develop a much more sophisticated understanding of what these three things are throughout this course than you would have in that very intro 2 or 3 day lesson you got before. Okay, so let's start off with assets here. So, what are assets? If I asked one of you who's seen them before, you might tell me asset is something a business owns. And that's true. That's basically right. Okay, so anything a business owns, we'd call that an asset of the business. And one of the things a business has to do regularly is list all of their assets, everything that they own. So, what are some examples of things a business can own? Cash is a basic one. The cash a business holds presumably in its bank account, is a very clear asset. It's an economic resource that the business owns. It's controlled by the company. It has a dollar value to it. Cash is just worth whatever amount of cash you have. And cash is used to provide future benefit to the company to help generate revenue. The cash that a business owns isn't just sitting there. We're going to use that cash to try to create a profitable business. Okay, so some other examples. Another couple easy ones: trucks and buildings. If a business owns trucks or buildings, we would list them as assets at the value of the truck at the time we bought it or the building. We'll talk about that later and when we talk about the cost principle. A couple things to mention here: assets can also be things that are intellectual property, like patents, so they don't have to actually exist in the real world anymore. We might say that a patent protecting some intellectual property could be an asset as well, but that'll be later in the course. So anyway, I hope that term asset makes sense. It's just anything of value that is owned by a business. Okay, an inventory, if you haven't seen that before, is just basically unsold merchandise for a merchandise business. So if you're a shoe store, any shoes that you haven't sold yet that are sitting on your shelf waiting to be sold to customers, that's still an asset because the business currently still owns those shoes. Okay. Once we sell it, we'll turn it hopefully into a profitable transaction. Same goes for the shoes sitting in the back room or shoes in the warehouse that we haven't sent to the shop yet, all that good stuff. So assets are there. Liabilities is next. So liability is super simple to understand. A liability is just something that our business owes. So similarly, we have to regularly list off our liabilities, and we'll always have a good ongoing record of this, of all the different debts that a business has. Okay, so a liability is simply a debt obligation based on some past transaction that the business has done that has to be repaid at a later date. Okay, so just think about it as debt. Examples of liabilities, you might see something called a loan payable. If the business took out a loan and we still have to pay it back, we're calling it a loan payable for whatever amount that we owe. Very simple. Mortgage payable. If the business took out a mortgage to buy property, that'd be a mortgage payable. Things like unearned revenue, we'll talk about later in this course as well, and that will also qualify as a liability. Okay, so if assets and liabilities make sense, that brings us to equity. Equity is simply the difference between our assets and our liabilities. So if we take all of the business's assets and we subtract all of the business's liabilities, everything we own minus everything we owe, we're going to get a number. Hopefully that number is positive because that means we own more than we owe. If the business owes more money than our assets are worth, that means our equity is in a negative position. Okay, but hopefully our equity will always be in a positive position. Another way to look at equity is that equity is what's left over for the owner to claim of the assets of a business after our creditors are entitled to their liabilities back. So let me make that make more sense with an example. So let's say you have a business. You take track of all of your assets, and your assets are worth, let's just say, $1 million. And let's say your liabilities right now for your business are $300,000. So you, as the owner of the business, might like to say, well, look, I own the business. The business's cash is my cash. Whoops. Business cash is my cash. So that $1 million is my $1 million. The trucks are my trucks. That $1 million belongs to me as the owner. However, you wouldn't be able to do that because legally speaking, a business has to pay back its liabilities. The creditors, the people you owe money to, are legally entitled to that before you are. If your business goes under, they get back their 300,000 first. So that's why we would say the owner's equity of your business isn't a million, it's $700,000. Okay, because those creditors are protected before you are. The last thing I'll mention on this slide, just very quickly, is you might hear me using the term equity a lot. I like to say equity. Owner's equity is always right in terms of how I'm talking about it, but you might hear it called partner's equity or shareholder's equity. It's basically the same thing, except it just applies to a different type of business. Okay, so you're talking about a partnership business. If you own the business with 19 of your friends, you're not a sole proprietorship, you're a partnership. So the partner's equity is the owner's equity. Or if it's a corporation we're talking about, like Tesla, Tesla is owned by shareholders. So instead of saying owner's equity, we say shareholders' equity. So I hope that makes sense as well. All right, so let's get into that equation really quick, and then you'll do some examples, and yeah, then we'll move on from there. So let's practice the equation. So what is the equation? Well, I've already kind of been through it. So what is owner's equity? Owner's equity is the assets, what we own, minus the liabilities, what we owe. Hope that makes sense. If we rearrange this a little bit, we get the fundamental accounting equation. So the fundamental accounting equation, we just rearrange this, is assets equals liabilities plus owner's equity. And it's for the reason that I just kind of said, right? The business's assets, that $1 million that I said you own, is divided between your liabilities, 300K, and what's left over is the equity that is, belonging to your owners, 700K. So left side equals the right side. Assets equals liabilities plus owner's equity. This way of arranging the equation is also the way you're going to see it on balance sheets. And that's another reason why we're going to put it that way. So let's do some very simple calculations. Let's say you have 2 of these and you're missing 1. That's one of the first skills you're going to learn in this course. And again, it's a simple one. So let's say business number 1 here has $1,000 in assets and $800 in liabilities. What's the owner's equity in this business? Well, it would be $200. Okay, because owner's equity is assets minus liabilities. Say business 2. Business 2 doesn't look so good. So business 2 has 710K in assets, but look at our liabilities. It's even more, 845K. So here we'd have a negative owner's equity. So our owner's equity is negative $135,000. All right, and then we can look very quickly at business number 3 as a third example. So business number 3, you're told that their owner's equity is $150 million, and this business has $95 million in liabilities. What are the assets? So a way you can always solve this, depending on what you like to do, is always just by plugging it into the fundamental accounting equation. Assets equals liabilities plus owner's equity. So here, assets, we don't know yet, equals $95 million, which as you can see, is our liabilities, plus our owner's equity, which is under $50 million. So here the assets of the business are $245 million. Okay, so you can solve this quickly, intuitively. You can plug it into the equation. You can do rearranging if you need to, but it should be pretty basic. So now that I've given you some examples, I want you to give it a shot here in Edpuzzle for the bottom 3. Okay, so this is business number 1. This is business number 2. And this is business number 3. So find what's missing. Find what's missing for each one. Okay, give that a shot. And there are your answers up here. I hope that makes sense. Please let me know if you have any questions. What's big for now is not to get too focused on just the arithmetic. It's not meant to be like grade 7 math. It's meant to be sort of understanding the relationship between assets, liabilities, and equity, and we'll practice that as we go forward. Okay, so just before this video ends, I promised you a quick question to help you start thinking about the term equity. So here's that question, or questions, I should say. I want you to consider this. Now that you know what equity is, that owner's equity equals the assets of a business minus its liabilities, you know that positive equity is good. We want our business to own more than we owe, obviously, and negative equity is bad. If we owe more than we own, we're in bad shape in terms of our current financial position. And it's going to get more nuanced and complicated than that. But consider these 2 questions. If a company has positive equity, is it always necessarily doing well? And if a company has negative equity, is it always necessarily doing badly? What's kind of missing here? So think about that for a sec and pause it. Okay, so obviously, again, positive equity, good. We want owner's equity to be a number above zero, and negative owner's equity is generally really bad. But I just want to give you some counterexamples to show you that there's more to it. So a couple companies you know about, Tesla. So this was current as of this summer. So Tesla right now, if you look up their balance sheet, which we're going to do very soon in this course, it tells you how many assets Tesla has and all their liabilities as well. So Tesla currently has $29 billion in assets and only half a billion in liabilities. So their owner's equity is, you can do it, $28.5 billion. Very good, very positive. That's a great ratio. So it seems like, whoa, that's awesome financial position. They're not really in any kind of trouble with debt. They own so much more than they owe. But it could give you a slightly misleading picture because if instead of looking just at what they own and what they owe, Tesla as a business, in terms of their sales and how much money they're spending, even though their equity is super positive, is currently losing about $4 billion a year in terms of actually selling cars and their business operations. So their equity is really good, but it might not stay good with that current profit loss. And another example of a business right down the street, a Canadian business in this case, is Dollarama. So Dollarama, if you look at their assets and liabilities, it's a negative equity. Their assets are less than their liabilities. Their owner's equity, as you can calculate, is negative $0.2 billion. So it's a poor financial position just looking at total assets and total liabilities. However, Dollarama is very profitable. They're making $500 million a year. So even though their current owner's equity is negative, it might not stay that way because they're making so much money year to year that it's probably going to go up, right? Their debt's not likely to go up and their assets are likely to grow. So I hope that makes some sense and gets you thinking a little bit, and we'll talk about it more throughout the course. So thanks so much for watching. I'll leave that on the screen. This is what we talked about, and please let me know if you have any questions. And yeah, I'll end it there. Thanks, guys.